Good day everyone. Today we are exploring the fundamental processes involved in procurement and purchase requisitioning. This cycle is critical for ensuring that an organization acquires the right resources efficiently while maintaining strict internal controls. We will walk through the four primary stages. First, ordering; second, receiving; third, approving; and fourth is disbursing. The process begins with ordering materials, supplies, and services. This activity is triggered in two ways. Either inventory reaches its predetermined reorder point, or a specific department identifies a need for goods and services. Once a need is identified, the requesting department prepares a purchase requisition (PR) and sends it to the purchasing department. The purchasing department then takes the lead to identify suitable suppliers, evaluate those suppliers by comparing prices, quality, and terms, and lastly, select an approved vendor that best meets the requirements. The final step in this stage is issuing a purchase order (PO) to the selected vendor. This structured approach ensures that every purchase is necessary, authorized, and cost-effective. Moving to the second stage, we have receiving goods and services. When the supplier delivers the items, the receiving department must perform a diligent inspection. The process involves checking the quantity and quality of the item received, comparing the goods against the original purchase order to ensure accuracy, preparing a receiving report (RR) to document the condition of the items. If the goods are in good condition and match the order, they are accepted into inventory. This stage is vital because proper inspection helps prevent the organization from accepting incorrect or damaged goods.
Okay, for the third process is approving the supplier invoice. After receiving the supplier invoice, the account payable department perform a three-way match by comparing the purchase order, receiving report, and supplier invoice. Payment is approved only if all three documents agree. Payment is not approved until discrepancies are resolved. This prevents error and fraudulent payment. Okay, the last process in this expenditure cycle is cash disbursement. Once the invoice has been approved, the accounting or finance department prepares payment according to the agreed credit terms. After payment is made, the transaction is recorded in the accounting records and the account payable balance is updated. Proper authorization and documentation ensure that only valid payments are made.
Assalamualaikum and hello everyone. For this part, I will explain the suggested control procedure to overcome the weakness identified in the expenditure cycle. These control procedures are important to ensure that purchasing, receiving, and inventory activity are properly monitored, authorized, and protected from fraud or error. So, they have 5 activities. There is no restriction in making purchases requests, no authorized approved list of suppliers, no authorization on the order made by the clerk, no copy of the order being sent to the receiving clerk, and lastly, no restriction on access to the stock. So, the first part is no restriction in making purchases requests. So, the effect of the weakness is unauthorized employee may request unauthorized purchase, which can lead to overspending and excess inventory. So, how to control it? Only allow authorized employee or manager in making purchasing requests, ensuring the purchase made does not lead to overspending. So, the second part is no authorized or approved list of suppliers. So, the effect of the weakness is the company may purchase inventory at the highest level of price since there is no approved list to evaluate for competing pricing. So, how to control it? How to control it? With create an approved supplier list and to ensuring the company is purchasing inventory at the lowest price with the highest quantity. The third part is no authorization on the order made by the clerk. So, the effect of the weakness is a purchasing clerk may unauthorize the purchases. So, how to control it? How to control it? With assign a supervisor to review and approve the purchasing order before sending the order to the supplier, ensuring the purchases are properly monitored and approved.
Hello and Assalamualaikum. My name is Muhammad Anik Nabil bin Muhammad Yusnizam and my ID number is 2026559119. So I'm here to continue what my friends talked just now, and I'm gonna continue with the no copy of the order is being sent to the receiving clerk. So what is the effect of weakness for this issue? So the weakness is the receiving clerk cannot verify the goods delivered to match the item ordered. It is because there was no copy of the order, thus increasing the risk of accepting incorrect goods. So how to overcome this? We can overcome this by the purchase department need to send the copy of the order to receiving department for verifying the goods received to make sure the materials are same as the purchase order. So moving on to the next one is no restriction on access to the stock. What is the effect of weakness of no restriction? So the inventory can be stolen or used without authorization, which can cause inventory shortage. Yeah, if you think logically, when something have no restriction or no user selecting, so the possibility to have shortage in inventory is high. So how do we overcome this? We can overcome this by restricting the access to the stock to personnel who are authorized only. So it can prevent the inventory from being stolen or misissued. Thank you.
Assalamualaikum and hi, my name is Muhammad Akil Irfan bin Nur Azizi, student ID 2026-761229. And lastly, I will present to you the fraud risk in the expenditure cycle. There are 3 risks in this case. The first one is the kickback fraud schemes and asset misappropriation. Secondly, billing schemes or cash disbursement fraud. And lastly, conflict of interest, bribery and vendor fraud schemes. Firstly is the risk of kickback schemes or asset misappropriation, which is inventory theft. The finding in this case is the items were being ordered in quantities exceed what the department actually required. The risks are the risk of unauthorized or excessive purchase, while the consequences for the risk is excess inventory, higher storage costs, and inventory theft or wastage. For this first risk, the discussion here is a purchasing agent may be intentionally over-ordering inventory or supplies in collusion with a supplier to inflate the supplier's sales volume. In return, the employee receives a financial kickback or a side payment. Alternatively, this reflects a high risk of inventory theft. An employee could be ordering excess materials on the company's tab and subsequently diverting the surplus items for personal use or unauthorized resale outside the organization. The second risk is the risk of billing schemes or cash disbursement fraud, which is, in this case, stated that the processing payment despite mismatch the document. The finding here are the payment process, although the document did not match the delivery, which conclude to the failure to perform proper document verification. So, the consequences for the risk are the fraudulent payments, financial losses, and inaccurate accounting records. For the second risk, it is a standard expenditure cycle, which is a three-way match that must be verified before the cash is disbursed. Processing a payment despite mismatched document indicates that an employee is intentionally overriding internal control. This risk usually materializes a billing scheme where the company pays for short deliveries or entirely phantom goods, with the illicit gain split between the complicit internal staff member and the external vendor. And lastly, the risk of the expenditure cycle are the risk of conflict of interest, bribery or fictitious vendor schemes. It is the personal financial interest in these new vendor entities which conclude to a conflict of interest. In this case, we find that the new vendors with little track records were awarded large contracts while established, while the reliable vendors were bypassed. This can make the consequences to supply disruption and lack of accountability. This last risk is a red flag points toward procurement fraud. Meanwhile, a purchasing manager or executive may have a personal financial interest in these new vendor entities, which can make them have a conflict of interest, or they may have accepted the bribes to bypass the company's standard competitive bidding process. In a worst case scenario, these untracked vendors could be a shell companies created entirely by an internal employee to submit a fraud, inflating invoice for service or good that are never actually rendered. And we have come to the end of our presentation for expenditure cycles. Thank you.